Good morning and welcome to this Charge Up Europe webinar on prices and pricing. In a few European markets, pricing in the EV charging sector has increasingly come under scrutiny, with court rulings, public debate, and questions from consumers about how charging prices are set. At the same time, the sector is evolving rapidly, and with it, the complexity behind pricing. This webinar is an opportunity to lift the veil and peek under the hood. We're going to unpack the cost structures and key cost drivers that shape charging prices. Our exchange will help bridge the gap between perception and reality and support understanding of how prices are formed. This will be a two-part series. Today, we will be looking at cost drivers for CPOs, and a second webinar will look into the role and value of EMSPs. I am delighted to be with Peter Badik from GreenWay. Peter, let's start. Please tell us about you and about GreenWay.
Hello, Lucy. Thank you for having me on the interesting podcast. The Peter Badik, I'm the founder and currently chairman of the board of the GreenWay, which is the CPO operator in Poland, Slovakia, and Croatia. We are on the market for more than 15 years and providing the public charging services for EV drivers in these countries.
And also a board member of Charge Up Europe.
And,
You've been in this market
once again, yeah.
No, that's good. You've been in this market for 15 years, Peter Badik. Can you please give us a quick sense of how is competition today in the EV charging sector?
Well, I would say the one word is abundant. It's a really very diverse group of companies, some of them smaller, some of them big ones, some of them pure players, some of them are part of the larger companies, either utilities or oil and gas companies. But generally, I would say that there are a large number of very matured players who learn a lot in the past 10 years about how to do this business. They are scaled up to reasonable size, so they are as well cost effective and generally are able to serve various use cases. Obviously, it's charging on the route, on the highways. I'm sure that all EV drivers are using it, but as well there are companies focusing as well on charging in the cities, slow charging, or providing the DC charging in a shopping malls or places where you use your time. There are as well a bunch of companies who are providing and helping the fleets to electrify in a places which are not necessarily public, but in private areas where the fleets are charging their cars during the work. So abundance and diversity is, I think, what characterize today market environment.
Thanks a lot, Peter. So you've prepared a restructured presentation to share with our audience today. Can you let us know what we're going to be looking at in this presentation?
Yes, I prepared kind of a deep dive into the charging costs of the charging point operator, typical charging point operator in Europe. Here, I want to make a note that obviously it's very hard to prepare one example because the diversity of cases are very big. As I said, there are large charging hubs that you have small AC chargers, you have big hub with several megawatts, you have transit locations, you have city locations, you have small player, small CPO, you have a larger CPO. So there is a number of things which influence the cost of the charging. So please take it with a little bit of salt because this is really a generic example. It shouldn't suggest that this is something which applies for everybody in every situation. But nevertheless, I think we will be able to deep dive into the structure and provide kind of a basic understanding what are relationships between different cost types.
Super. Then please walk us through it.
Okay. So we built this example on several assumptions. One of them being that we used the very typical 400 kV chargers, so 400 kilowatt chargers, the charger which you probably will meet on the highways, sometimes even in the cities, providing the fast charging, very typical technology used these days. We will describe, as I said, the most important cost drivers, and then in the second part of the presentation, we will summarize and describe what can be done in order to decrease this cost? Because I think that's something which everybody are interested, how to drive the cost of the charging down. So we will provide a few suggestions or practical examples how the cost of charging, I mean by that the cost of kilowatt hour, which is paid by the EV driver, can be reduced. Okay, so without further ado, I think we can go and item by item explain the things. So let's start with the first one. Obviously the first thing to start is the capital expenditures. So basically, those are the costs which the CPOs needs to pay in order to acquire the technology. Typically, it's very good to look on that at least in two parts, and the first one being the cost of the chargers itself, typically the DC chargers in this example, and then the cost of the installation and all the other things which you need to do around that. Obviously, what the people usually see is the DC charger or the charger itself. So that's what when the EV driver or people on the streets think about the charging, they see this. This is the infrastructure, but it's not only that by far. Especially in a situation where you have larger installations, so-called charging hubs, so where you have more chargers in one location, the quite a big cost needs to be paid as well to transformer station, to civil works, to cabling. You may pay for roofing if you need to put a roof on the top. So those are the costs which can actually, if you look on a typical hub with the several chargers, can cost more than just the charging technology itself and the charger. Why it is important in terms of the cost per kilowatt hour, which is the amortization. So obviously, every investment which just put on the ground by CPOs needs to be recovered. So it needs to be paid back. And here it's important to look on what is the time frame within which the technology can live and serve, and so which define the time frame in which the technology needs to be repaid back. So it's in terms of the charger, the typical amortization which our CPOs are using is about 10 years. In terms of all other things, it can be 20, actually even sometimes even longer, maybe 30, 40 years. And this applies for cabling, transformer station, and then civil works, because sometimes you need to build the roads, you need to pay the pavements, and so on and so forth. Those typically can stay and live much longer. What is obviously very important here is that the CPO very often doesn't own the land. So very critical in this respect is basically the length of the contract for which the CPO can use the specific location, because some of these costs which I'm mentioning here is not possible to recover if the contract for location is finished sooner than let's say within this 20 years.
And Peter, I think it's also important to recognize, as it's very clear on your previous slide, that investments are done for the long term for CPOs, right? As long amortization time windows.
Exactly. And in fact, if we look on the length, the 10 year is a kind of a minimum, because that's for the amortization of the charger. But as I said, especially in case of the larger hubs, all other costs can actually be amortized and should be amortized for much longer. Otherwise, we will need to squeeze and the repayment of these costs to shorter period of time, which translate into the higher cost of per kilowatt hour. Second element, which very much links to CAPEX, basically the installation and cost which needs to be spent by CPOs, is the financial cost. Everything which we build needs to be financed, and there are generally three types of the sources of capital in industry. It is the equity, so something which shareholders typically provide, and takes this equity as well takes the largest risk. Subsidies, and more recently some more senior instrument like senior debt or bonds. Why it is important is that every type of the capital has own costs. Maybe aside the subsidies are provided usually by public bodies without need to pay any interest on that. But on the other side, in terms of the debt and bonds, that's very obvious. You need to pay the interest to the banks. And in terms of equity as well, maybe you are not paying the interest, but if someone decides to invest into the charging, obviously the entity expect certain return on the capital. So if you put all these things together, you can have something which is called a weighted average cost of capital. And this is a very important element in a cost structure. I'm using here the example of weighted average cost of capital of 10%, which could be considered as a good one for matured CPO who is able to combine various type of the financing, including, for example, the debt financing or bond issuance. Obviously, if you, as a CPO just starting and you don't have a track record, you are not have access to, for example, debt financing, or in some situation there is no available subsidies, and you will rely purely on the cost of the equity, then your financial cost is going to be significantly higher. Here is therefore very important that the CPOs are more matured, gaining the size. The market is consolidating because it is the nature of the market that if you are larger, more sophisticated, you have usually lower risk and you are able to decrease the cost of your capital.
Peter, can I ask you to expand a little bit? Again, you're mentioning debt and bonds and how recent that is, just to make sure that there's a good understanding that those are not necessarily financial instruments that are very broadly available for everybody on the market.
This is a very good question, and actually a very big topic in our industry these days. I would say time-wise, we see that in larger scale, this kind of a senior debt instruments are present in our market since last 3 years, probably only. So there were some examples before, but if I look generally across the whole industry, it start to gain the relevant in the last 3 years. It started to gain relevant quite quickly, honestly. And if you look on 2025, actually, there was already a large amount of money received by CPOs in terms of this kind of senior debt and bond instrument than equity or subsidies. Why it is so? It's generally linked to the risk of the business. The charging is by nature infrastructure which doesn't have secured revenues. It's almost impossible to sell your revenue stream for long-term forward. So, for example, if you build a wind power plant or solar power plant, you as a owner of this equipment can rely on a long-term PPA contract. So you sell your production to some buyer for many years, so 3, 4, 5, 10 years, and you have certain guarantee of the income. In case of the CPOs, this doesn't exist or exists in a very, very small portion of their revenues. So basically, they need to rely on the revenues which are coming from the EV drivers as they come. And obviously, there is a competition. You need to fight for your customers and so on and so forth, which means that this infrastructure is perceived by the provider of the capital as a risky infrastructure, no guarantees, revenues, which then basically translate to the fact that despite this EV charging industry exists for at least 12, 13 years, the more matured financial instruments are available for our industry only in the past 2-3 years. So let's go to another very important element, and that's the DSO fees. DSO fees is very complex. It's very complex because we have so many various DSO structures and in Europe. Just to give you a flavor, in Germany, we have more than 100 DSOs, while in France, we have 1. So as well, the structure of their fees depends very, very much on their policy. So this is one of the big struggle for operators which are working across many countries, that they actually needs to work with, I would say, too many various fee structure charged by DSO. Maybe for explanation, for those who don't know, DSO stands for distribution system operator. So it's the energy utility which basically operates the last mile cables, which brings the cables to the site where the charging point operator can connect their infrastructure. Why it is important and why the structure is so important? Because you have typically 2 times of or 3 times of the fees which you pay as a CPO to the DSO. The first one is the fee for grid connection establishment. So basically, it's a fee where if you want to connect your new charger, you need to approach the DSO, and they need to create or arrange the connection, and therefore, for that they require some payments. Again, it depends very much country by country or DSO by DSO. Sometimes this fee is generally as a kind of a price list. So we say, regardless of what you are connected and how much you connect and how complicated the connection is, you pay the same fee. Some grid operators are asking for true cost of establishment of the connection. So if you need to bring your cables through, I don't know, 500 meters through very complicated environment, through some existing roads and so on and so forth, the grid connection can be really, really big. So here, the first thing to navigate is, do I pay some price list based on, let's say, the power which I request, or do I pay a true cost? And again, depending CPO by CPO. The second type of the cost, and maybe to mention that obviously this the grid establishment costs are usually part of the capital expenditure, which I mentioned before. Then you have typically some fixed fee, usually paid monthly or quarterly, for so-called grid capacity. It means that if you as an operator wants to run the charger, you need to have assurance that you will be able to get certain power from the grid. So the DSO reserve a certain capacity for you. This capacity charge is sometimes it's called the capacity charge, sometimes it's called grid access fee, whatever the name can vary. This is usually a fix. But here is a trick, because the third element is a variable fee, which is calculated per every kilowatt hour. So not for power, kilowatts, but kilowatt hour delivered. And there could be a very different regime between various DSOs, how these costs are split. Some of them has very high fixed fee and low variable fee. Other has very low fixed fee and very high variable fee. And plus, sometimes this variable fee is mixed together with the cost of the energy. But I would put aside this example because that makes it a little bit more complex. What is important for us to remember for the purpose of this discussion is that there is an interplay between high fixed fee and low variable, or vice versa. And I will later on show how this can significantly influence the price per kilowatt hour, which the CPOs needs to charge.
Peter, so that is a snapshot in time in terms of how those fees are structured. Can you give us a sense in your markets of how those fees have evolved? One thing we're hearing from members, especially those who have a strong footprint in Germany, that essentially they've gone up quite significantly in the past years. Is it also something you've seen from GreenWay, or is that less pronounced in your markets?
This is very important element which can help the rollout of charging infrastructure, or it can be quite a big barrier for rollout of charging infrastructure. It needs to be understood that the charging at the moment across basically almost all countries in Europe, maybe with some exceptions, are still rather underutilized. So we do not reach sufficient utilization in many locations. And in a situation where you have to pay a very high monthly fee, this is obviously something which has a big problem for profitability of the specific charging infrastructure. So actually, the structure of the DSO fees can significantly help or derail the rollout of charging infrastructure. I will give you an example later on about the specific case in Poland where the fee has been specifically defined for the connection of the charging, and where basically in a situation or until the moment where the utilization low, the structure of the fee is rather towards more variable fee and less fixed fee, while when the utilization of the specific location increase, it flips, and the more is on the fees on the fixed side and less on variable. This allows the much sooner rollout of especially large charging hubs. So to sum it up, if there is a will to support the rollout of charging infrastructure, actually adjusting the DSO fee properly can be extremely a good tool. Let's move to the another element, and that's cost of electricity. Here, and then when I talk about the cost of electricity, I'm talking about the commodity. So something which is not linked to the regulated fee of DSO, but it's something which you buy from your energy retailer. And contrary to the popular belief, this actually represents relatively small portion of the cost of the CPO. Obviously, again, it depends on the use case. If we will talk about the AC charging, the portion of the cost of electricity as a commodity and the overall cost will be higher. If we talk about the DC charging, it will be significantly lower. But what I want to stress here is that the commodity itself, is in the case of the most common DC charging infrastructure, relatively small part of the cost. So if we look now on the current situation and variability which we see on the energy market, which can influence as well the cost of energy, it may have impact the cost of the charging, but the impact is not going to be definitely one-to-one. What is another element which I would like to point your focus is the energy losses, because sometimes it is forgotten a bit. What we can define the energy losses as a kind of additional cost of electricity which needs to consume. Energy losses are generally the electricity which is not which is consumed by the charging point operator but is not delivered to the cars. And there are two types of the energy losses: heating and cooling of chargers consume energy, regardless of number of sessions which we deliver. The charger needs to be heated during the winter, because otherwise there will be a huge humidity and the water can destroy the electronic inside of the charger. On the other way around, when there is too hot, the charger needs to be cooled, even if it's not used. So there is a certain type of the losses which needs to be covered regardless of how many kilowatt hour you sell. Another type of the losses which you need to count with in your business case is the losses during the charging. And here again, it links to specifically AC/DC transformation process and the delivery of electricity through the cables to the car. This is especially a case for high power DC chargers, where this can be a relatively important element of your cost, because this is the electricity which you need to pay, but it never reach the customer. And this is done only during the charging, active charging, which means that it actually relates to the kilowatt hour. So it can be considered as a variable cost, which is linked to the kilowatt hour which you deliver to the car. So again, you have two types of losses. One is a more or less fixed cost, because you need to heat or cool your chargers regardless of how many kilowatt hours you deliver. And second can be considered more as kind of a variable cost, because it's happening only during the charging. So it depends on a number of kilowatt hours which you deliver to the car. Okay, and let's go through the last group of the cost, and that's the location cost. Location costs are typically a rental cost, which the CPOs pay to someone who owns the land where the charging is built. It can be a private partner, so let's imagine a shopping mall, or a public authority in case of, for example, the highway, where the public authority organize some tender and provide a concession or sell the concession to the CPOs. Usually it has two elements. Very typically there is a fixed fee per usually counted per parking place or per square meter, which is paid on monthly or yearly basis. And then there is a variable fee, or sometimes called a revenue share. So either in a private setup with the private partners, or very often as well, a part of the concession is the requirement for the operator to pay a certain percentage of the revenues, or it can be set as a certain amount of euro cent per kilowatt hour delivered to the charger. So these are the amounts which is paid to the landlord or public authority. And then there are other costs which are related to running of the business. So let's say one element, a very important one, fixed cost of the management, service, and maintenance of charging infrastructure, where you can imagine everything from cleaning, solving the incidents, the faults, the yearly maintenance, and all these things which you need to do around your charger. And then there is as well the quite big group of a cost which basically needs to be provided by the operator in order to, so to speak, run the business. So everything which is a general overhead. So the CPOs needs to have accounting, controlling. They needs to have people who take care for IT system. Actually, the IT capacities or IT competences is a very important part of the CPO business these days. So those are all the costs which needs to be, let's say, spent in order to run the business properly. Okay, so how all these costs translate into the overall picture. So here we represent the cost from the previous example, and we are assuming the charger with a utilization of 70 kilowatt hour per charging port per day. This is rather on the low end of the utilization, but I would say it's not untypical for charging infrastructure across the Europe these days. For sure, you have better examples where the utilization can be much higher, but definitely, unfortunately, there is a lot of chargers with a lower utilization than this one. So as you can see here, the electricity purchase price, that's the one which I said is a relatively small portion of the overall cost. On the other side, the cost related somehow to the energy, which is the DSO capacity cost and variable grid connection cost, represent quite significant portion. Then we have in this example about a quarter of the other costs which are linked to cost of the chargers, so depreciation cost of the hardware, depreciation cost of installation. Why it is smaller here, relatively smaller? Because we depreciate for much longer period. So while the charger is depreciated for 10 years, all the other things we use depreciation for 20 years. Actually, it could be a little bit more. As you can see, the financial cost with a given example of 10% weighted average cost of capital represents a relatively big part of the cost, even comparable to the cost of the electricity. And then you have these all other costs, rental bills being still quite high, a big portion of the overall cost in this setup, a revenue share as well, and then the other things related to operation and billing and things. So that's the summary of the cost, and now we will move forward in the presentation with some explanation how these costs can be reduced or what influence or can drive the reduction of the costs.
Peter, before we dive into certainly how we can help decrease the cost of EV charging, maybe we pause for 1 second and stay with the topic of transparency, which has also come up in policy discussions in some market. Can you give us a sense of how GreenWay is ensuring transparency on prices for their customers today? What does it look like concretely for a company like GreenWay? How do you ensure that?
The price transparency for the drivers is extremely important for every CPO or EMP because that's a part of the user experience. So I would say every CPO and EMP has the primary interest to be perceived as price transparent. Otherwise, it basically lower down the trust of your customers and probably will then impact your revenues because they will go to someone who they perceive more transparent. So there is, I would say, very natural drive for every CPO to be considered as a fair player on the market vis-a-vis on customers. In practice, it means that the charging on the locations are clearly displayed and understood. For someone who is not a direct customer of the specific CPO of the specific charger, has a possibility to charge via using the payment card on the payment terminal, where the price needs to be clearly communicated. The things become more complex for the benefit of the EV driver when you become the customer and you are registered and you are able to use a various price offer of your EMP and the CPO. Then typically your interface is your mobile app where the price should be communicated. But this is obviously something which allows then the direct communication with the customers, which allows the price to be adjusted to the specific situation, to the specific needs of the driver, to specific subscription which he or she decides to use, and therefore the variability of the cost or the prices there are much bigger. But again, it's for the benefit of the driver because they can apply their choices and decides which subscription program, which time of use they are using, and can benefit for the lower price. So simple use on the charger needs to be transparent, the price needs to be given, but then the drivers needs to have a possibility to go into more structured environment where they can certain benefits, and then they are informed in that environment about the current prices.
Thank you, Peter. You were mentioning earlier that the situation of underutilization of networks across Europe. Can we, despite the fact that that parameter is a pretty hard parameter, do you still have ideas on how we can contain or mitigate, or if possible, even decrease the cost of EV charging?
Very good question, and then actually part of our presentation going forward. So we will now go through the several items or suggestions which can lower down the cost of the charging, and we will start with the two big things. The first one is, as you mentioned, the utilization, and second one is a DSO fee structure. So let's deep dive. Why the utilization matter the most in a cost of the charging and then in the price of the charging is that it influences basically almost every item of the cost structure which we have been explaining before. So we can fairly say, depending again on the situation, depending on many circumstances, that could be 70 to 90% of the cost of the charging is somehow influenced directly or indirectly by utilization. So let's go item by item. Obviously, the amortization there is very clear. You need to pay for your chargers. You need to amortize a certain amount every year from your charging infrastructure. And if you are able to amortize it across the larger amount of the of kilowatt hour which you sell, then the cost per kilowatt hour decrease. I think that's pretty straightforward. Financial costs. Again, the same thing. If you need to finance 1 million euro in a charging infrastructure and you pay, let's say, 10% weighted cost of capital as in our example, then it's translated in 100,000 euro which you need to pay on this cost. And if you are able to spread it across more kilowatt hour, then the kilowatt hour could be lower. So that's, I would say, a direct impact of financial cost. But there is as well a indirect impact of utilization on the financial cost, and that's generally the risk of the business. As we discussed a few minutes ago, it is very important for the operators to be able to use the cheapest source of financing, which is typically senior debt or bond issues. This is possible even today, but still the interest rate is, let's say, more elevated and the risk premium asked by the banks are higher than for example, for another type of infrastructure, let's say wind farms or solar power plants. Why it is so is because the uncertainty and because of the uncertainty is translated into the utilization. So in a situation where the CPO is facing still quite a low utilization, it is as well perceived as a more risky business, and therefore the cost of capital is higher. So this is, I would say, a direct impact on the financial cost. So one is a direct, where you recalculate your kilowatt hour, your financial cost through large number of kilowatt hours. And an indirect is that the higher the utilization of your infrastructure, decrease your risk and decrease your financial cost. Fixed DSO cost, again, very similar as we showed on the picture before. The fixed DSO cost can be quite a substantial part of the cost, and if you are needs to pay this cost regardless of kilowatt hours, then obviously more kilowatt hours you sell, the lower the cost per kilowatt hour. The same go for rental cost, especially the fixed part, and some what I called maintenance service cost. This links to the size of the operation of the CPO. There is a certain cost which the CPO needs to pay regardless if it has a very small network or very large network. As I said, the IT competences, general overheads, and many other costs needs to be paid here in order to run the business. The small operator has a big disadvantage. They are not able to use the economy of scale, and therefore they need to translate their operational cost to the lower number of kilowatt hours. Those costs which are indirectly linked to the utilization is a financial cost, as I mentioned already, and the energy losses. If you have the infrastructure which has a low utilization, then there are certain type of energy losses which are paid regardless if you run or sell the kilowatt hours or not. So generally the fixed part or certain part of energy losses as well is influenced by the utilization, because they are considered as a fix. So let's make a bit of calculation, and what we used the same example, the same setup, but we now apply a bit with the utilization and show on the graph the average cost per kilowatt hour based on various utilization. On the bottom line, you can see the utilization running from 50 kilowatt hour per charging point per day up to 200 kilowatt hour per charging point per day. And as you can see, this is reducing significantly the cost of the charging. One can conclude that generally, just by increasing the utilization, without any additional spending by the CPOs, the cost of the charging can be reduced to half. Therefore, I would claim that the utilization is the most critical factor in the price structure of the CPO, and it's the main driver how the cost of the charging can be reduced. But here is one important thing to mention. If we want the charging infrastructure to be perceived as an enabler of the rollout of battery electric vehicles, as something which doesn't represent the kind of a bottleneck of the development of electromobility, we need to invest into infrastructure ahead of the rollout, and that's actually what's happening in Europe. We have abundance of the charging infrastructure. It means that the EV drivers now can really rely on very robust charging infrastructure almost in every country in Europe. But this goes with the expense. And the expense is that the utilization in many locations are still relatively low. This needs to be obviously changed. We need to work on the rollout of electric vehicles. The more electric vehicles we will have in Europe per one charging point, the better the profitability or the better of the economics of the charging infrastructure will be, and that's actually the way how we can reduce the cost of the charging going forward. Let's go to the second big element which can influence the price of the charging, and that's the structure of DSO fees. Here we use the very same example as we had before with a different DSO fee structure. This one is taken from one country in Europe where the DSO structure is such that the DSO require significantly higher fixed cost and in exchange for a lower variable cost of the connection. And in a situation which we're describing, 70 kilowatt-hour per charging point per day, this is the influence on the cost of the charging. The cost of the charging are generally much higher per kilowatt-hour, and the ratio or the proportion of the cost linked to the energy, especially to the DSO part, is much bigger. So by this, we want to demonstrate that the proper setup of the DSO fee can have a substantial impact on the cost of the charging and the price of the charging in specific country.
And I think you have a nice example from Poland to show how that can be done in the best practice way.
Exactly, Lucy. And we put here the Poland example where a few years ago the DSO introduced the specific tariff, which is available only for the charging infrastructure, and which dramatically reduced the monthly fee in a situation where the charging point or charging infrastructure has a low utilization, and flip in a situation where when the utilization increased. So there is actually automatic mechanism which set a certain threshold, and if your utilization is above certain threshold, the system flips. So at the beginning, you are benefit from low fixed and high variable, and then you flip into low variable and high fixed. But that's already a situation where your utilization is higher. This is calculated for every location, so it's specific for every location. So you may roll out the charges even in a location where you know that they are needed, and there is a demand for the charging, that the infrastructure is missing on that place, but you know that in the first few years the utilization is not going to be as good as in the future. This was one of the biggest push for charging infrastructure in Poland, especially if we talk about larger charging hubs connected to the middle voltage connection. What is as well worth to mention in this example that this is not perceived as a kind of a subsidy. In fact, the DSO is collecting the same amount of money over a longer period of time as if the standard tariff would apply. But for the rollout of charging infrastructure, it's important that there is a benefit of lower fees at the beginning where the utilization is low. So we mentioned two big things which can reduce the cost of the charging, and that's the utilization and structure of DSO fees. And now there are several others which can add a bit to the decrease, but if we put them all together, it can be as well a very important contribution to the lower of the charging cost in Europe. The first one is depreciation and asset life. We explained the basic relation, and here is very important that the CPOs are able to use the charging infrastructure on the location where they build it for a long period of time. So if we talk about the location where the large amount of money needs to be spent for transformer station, cabling, the civil works, it is very important that the rental contracts which goes with that, or concession which is provided by the public authority, is for a long period of time, because that's the only way how the cost can be recovered. So 20, 30 years rental contract or concessions is a good advice for any public tender or any landlord who wants to have a CPO with a reasonable pricing on their locations. Financing cost. Here we talk a lot about the cost of capital and how it is influenced by the risk, which is in our industry. And here I would like to stress especially the predictability of the regulatory environment, particularly the targets regarding the battery electric vehicle adoption. The more stable environment we have, the more predictable rollout of battery electric vehicles, which are our customers, is then the lower the risk of the industry, the lower the risk premiums, and that's the way how we can reduce the cost of debt and equity in our sector. So the predictability of the regulation is one of the key driver of the decreasing of the financial cost for CPOs. Rental costs. At the moment, unfortunately, still what we see in many cases is that the rental contract for charging infrastructure are still very, very high. It's maybe a part of some kind of a land grabbing competition between the CPOs, which tries to be on the best locations. Sometimes it's put in a public tender where the only criteria is a price. On the short term, obviously, that's good for landlord, is good for public authority who receive more money for the concession. On the other side, all these things need to translate in the cost of the charging. So I would be very cautious when we talk about the public tendering, for example. What is the focus of the selection criteria? If it's only cost, this cost has to be paid by the EV drivers at the end. Another element where the cost can go down, it's generally the overhead and admin cost. And here there is a very simple thing which applies for every business: the scale, drive efficiency, and drive cost down. What we see on the market at the moment in CPOs is that there are already quite a lot of consolidation. The businesses are growing faster; they are getting bigger. And this is obviously something which can allow them to be more efficient, which can allow them to use sophisticated IT technologies, sophisticated technologies for running of their own processes. And here we have to say that our businesses needs to grow and needs to consolidate, and the players needs to be able to tap to the economies of scale. Grid cost, grid access cost, we already mentioned several times, but here I would maybe, except of this DSO topic, would like to mention as well other elements which are important for the decrease of the cost, and that's basically availability of various dynamic tariffs and long-term PPAs, which can be available for the CPOs. Another element is the linked with the electricity. Except of the grid access cost, which we already discussed extensively, there are as well the things which can be improved in terms of the purchase of the electricity as a commodity, availability of dynamic tariff in countries which can be used by the CPOs, or availability of long-term PPAs, so the contracts for electricity with a low price for where the CPOs commit to the certain, let's say, purchase of electricity over the many years. Can optimize the energy procurement and optimize the cost of the electricity which needs to be paid. So that could be an additional cost optimization factor. Revenue share, as we mentioned, very often, especially in a concession situation, there is a requirements to provide as well some kind of a revenue share to the landlords or to the public authorities. Very often there is a temptation to compare the cost of the charging with the cost of the electricity, and which brings to the conclusion that this revenue share can be really substantial. Unfortunately, I saw the deals where the revenue share was expected in a level of 20-30% of the revenues. This is something which is obviously not sustainable, because if we look back through this presentation, and I think it's very clear, the big part of the cost of the CPOs are fixed cost. And if we look purely on the variable margin, so the difference between the variable cost and the revenues the CPO has, this margin needs to be really healthy. Otherwise, it's not able to cover the fixed cost of the CPOs. So very large and unrealistic expectation in terms of the revenue share, again, is something which will not allow the CPOs to cover the fixed cost, and bill basically needs to be translated into the higher cost of the charging. And the last thing is the things related to the payment processing. Payment costs related to processing of the payments is something which in a small volume, but still can add to the cost, and any kind of optimization in this respect can be improved. So thank you for all of you for spending quite a lot of time with this explanation. Hopefully it shed a little bit of light into how the cost structure of CPOs looks like, what are the challenges which you are facing, and hopefully it will as well give you a bit of flavor what can be done in order to reduce the cost and at the end the prices of charging for EV drivers.